Tom Lee says mid-cycle rate cuts equal winner winner, filet mignon dinner. Today's CPI report all but solidifies a 25 basis point rate cut as the Fed's starting point in the process of getting back to neutral. Why this is so important is because anytime the Fed has started with a 25 basis point cut for the first cut, you have actually had a soft landing and markets have done very well, at least going back to 1995 until today. Examples of this are 1998 and 1995, where markets were up 41% 2 years later, in the case of 1998, and up 73% 2 years later in the case of 1995. Even 2019, when the Fed cut rates 25 basis points, 2 years later, the S&P was up 54.1%. In the case of the Fed starting with a 50 basis point cut, we have two recent examples of this. In 2001, the Fed started with a 50 basis point cut and stocks were down 30.6% 2 years later. In fact, 4 years later, the S&P was still down about 5% from the start of the first cut. In 2007, the Fed cut rates by 50 basis points for the first Fed cut. Markets were down 26.3% 2 years later, and 4 years later, markets were down 12.6%. The reason for this is most likely, at least from what economists can judge, is the pace in which the Fed needs to cut is really a signal of how much weakness is out there in the economy. Meaning that if the Fed can start with 25 basis points and go at this slow and steady pace of just cutting rates each meeting or every other meeting, then that likely means the economy is in an okay place. If the Fed has to start with 50 basis points, then we're probably too far up Schitt's Creek already. And just to go back to Tom Lee here, Tom Lee says Fed cut plus expansion in January 71, October 84, October of 87, July of 89, July of 95, and September of 1998. You have seen a 100% win ratio 12 months later with an average return of 16.5%. Now, here's where I kind of disagree with Tom Lee. I don't think we can say with any kind of certainty at this point we are mid-cycle. We could be late cycle as all hell. We could be 2 months away from a recession. Or we could be just at the start of another bull market. Maybe we were in a rolling recession this entire time, and maybe the consumer can start to recover if wages start to pick up and we do see inflation really start to level off. I do think in that bull case scenario, one bright spot is equity in people's homes. I don't know if you guys have been on Zillow or Redfin lately, but it seems like homeowners trying to sell their homes at these ridiculous prices are crazier than a bag of rocks. But I do think after a period of time of normalization in the Fed policy, the Fed cutting rates, call it 100 basis points or so, you will see some of those homes become a little bit more appetizing and people will start to sell their homes and buy new homes and wake up one day with a couple $100,000 of cash in their bank accounts, and that will stimulate the economy to some extent. So I don't pretend to be the most bullish investor out there. I think markets are mispriced for the risk that could be ahead. But putting on my bull cap here, that is a potential upside surprise to economic activity and could keep us out of a recession if you start to see home purchases pick up. As Nick Timmerhouse reports on X, the average 30-year mortgage rate fell to 6.29% last week, down now a full point from the high of 2024 in late April. Mortgage purchase applications are ever so slightly creeping higher from multi-decade lows, a sign of continued affordability pressures. And you could see the mortgage purchase applications index, a 4-week moving average since 2017, you are still way negative. You're still negative 40% on your year over year, metrics. But if we can see an improvement there, as the Fed starts to cut rates more, then that could be a area of strength. Warren Pies on X, though, makes a great point on the housing market and the economy. He says mortgage rates peaked at 7.25% in May and have fallen in a straight line to 6.3%, yet mortgage purchase applications have not responded. We expect lower rates to revitalize the market. However, it has not happened yet. He says if rates fall to under 6% and applications don't tick up, it's a problem. Now, before we go more in depth with what Tom Lee is saying today and what could be coming next for markets, I think we need to focus on the CPI report that came out today. And guys, let me tell you, I've said this over and over again, CPI is really no longer this big catalyst that it has been over the past couple of years. The economy is the number one thing that matters. If the economy is up here in magnitude of importance, CPI is like down here. The Fed's like here, okay? Why is that? Well, as long as CPI doesn't start coming in deflationary, as long as CPI doesn't start to accelerate again, then it's just going to take some time to get to 2%. We all know this. The Fed is starting to reduce rates. The focus now is, did the Fed wait too long? Is the Fed behind the economic curve? Are we going into a recession? That's all that matters at this point for equity markets. In fact, believe it or not, if we start to get some deflationary CPI reports, that's actually going to be a big negative for markets. And I think the odds of an accelerating CPI is pretty low at this point. And that's why, in a nutshell, CPI is really not this big catalyst that it was for many years. With that said, CPI came in hotter than expected today. Core inflation was 3.2% in August. Yes, the lowest since April of 2021, but came in at 0.28%. month over month. The median forecast from your major Wall Street banks that publish their estimates for CPI every month was 0.20%, with the highest estimate being Wells Fargo at 0.25% and the lowest estimate being TD Securities at 0.14%. You came in higher than even the highest estimate. But yet you still see the S&P 500 that, yes, did fall about 1.5% at the lowest point of the day today, but now that is almost positive again. But I do think the markets are blowing this off a little bit, just shrugging off this higher than expected inflation report, because 87% of the month over month increase in core inflation was shelter. And when you actually take a look at core goods was in deflation territory, and core services excluding shelter actually came in at about 0.08%. It was shelter that really sent this thing higher, which is the same as last month. The problem with shelter in CPI is the report, the CPI report from the government uses owner equivalent rent. So basically surveying homeowners, asking them what they can rent their homes for. When I tell you everything affects this, literally everything. The cost of living, insurance, your frickin' phone bill, your grocery bill, all of this affects homeowners' thinking or ideology of what they can rent their home for if they wanted to. The biggest thing that's going to bring down shelter inflation on paper in these reports is the Fed lowering rates. When rates go lower to buy a home, that's what's going to dictate kind of homeowners' willingness to mark down a lower number on these surveys. Because as home affordability gets better, then presumably you can rent your home for less. This is something Fed Waller and Fed Barkin have talked about in prior months, that actually the Fed keeping rates high may actually be hurting the shelter inflation. But when you exclude shelter inflation, inflation's gone. Like, there is no inflation. You're actually going to be running well under 2% inflation once housing or shelter inflation goes negative or goes back to something normal. Now, Tom Lee also shares this post from the New York Post that says the Dow nosedives more than 600 points after inflation numbers disappoint and odds of Harris winning the White House rise. He says this basically sums it up. And an FS Insight intraday alert, this is FundStrat's intraday alert, says August core CPI better than appears. I believe they mean worse than appears. I don't know if they're trying to exclude shelter here. Nonetheless, they say the Fed has a green light to start easing cycle, but 8-week malaise is still the dominant force. Tom Lee shares this post from Renaissance Macro Research that says bonds rallying after an upside inflation surprise is a massive tell. This is about the Fed waiting too long and downside risk to growth. It's something the twos versus the Fed funds has been telling us for weeks. And what Renaissance Macro Research is actually referencing is the new 52-week low today that was set on 10-year Treasury yields. 10-year Treasury yields actually got down to about 3.64% after rebounding throughout the day to some degree, up about 2.5 basis points from the low. 10-year Treasury yield sitting at 3.67%. So Renaissance Macro Research says the bond market's actually saying the Fed may be making a policy error right now, and even though CPI came in hotter than expected, the Fed's going to have to cut a lot regardless. And as you probably already know, for the past 5 days or so, the 2 and 10-year yield curve inversion has been back in positive territory. And this is what you can see from the 2 and 10-year yield curve inversion is when you are inverted, that's not when you go into a recession. It's actually when you uninvert is when you're just usually 3 to 6 months away from a recession. So now as we are uninverted for a couple of days, and likely going to continue to be uninverted as the Fed cuts rates next week, the stop clock, if you will, starts now to be on recession watch over the next 3 to 6 months. That's why I do take some issue with what Tom Lee said at the start of this video, that we are mid-cycle in the economy, that the Fed's going to cut rates, and that means stocks are going to do very well. I think it's far too soon to say we are mid-cycle and not late cycle. Now, if you take a look at CNBC today, basically everyone says 25 basis points is coming next week, and, well, we're probably not going to get a super dovish cut. Ed Yardini says ultra dovish cuts may be off the table after the CPI report. Although I don't agree with that, because I think most Fed officials understand that CPI is high because the Fed funds rate is high. That's the thing that's keeping shelter inflation high. Now take a listen to this clip from CNBC that's titled, "We're worried the Fed will be too slow in cutting," says Wisdom Tree's Jeremy Schwartz.
Morning, it was Wisdom Tree's Global Chief Investment Officer, Jeremy Schwartz. Jeremy, good to see you. Thanks for the time today.
Great to be with you, Carl.
Watching core come in a tenth hot and then watching yields go lower might suggest to some that the bond market is worried about the Fed being late.
We are definitely worried the Fed is going to be too slow. They were too slow during the hiking cycle. We're worried they're going to be too slow in this cycle. You know, we have our own measure of inflation that puts in real-time housing data. We see what inflation is today. It's a singular issue, really, of housing. You put in real-time data, and we have half the inflation, 1.2 headline, 1.5 core. The Fed should not be slow in getting to neutral. We'd like them to get to 4% below quickly.
So then why is there this rhetorical argument that somehow 50 basis points is out of reach?
People, it's funny that they say this is going to be a sign of panic. It's like if the Fed actually showed, like, what are the signs, what are the evidences that would be a sign of panic? It's just this is a status quo bias of the Fed. You say, well, what's the last time they actually did this? You go back to early 2000, and you really haven't seen a lot of examples of them actually making these more dramatic cuts. We do think that they should be going down quicker, and it would just be reflecting the current reality that they're at their employment mandate, inflation's going in the right direction, and they got to reflect reality versus a slow and deliberate process.
I don't know. We're also right before an election, and I'm not saying that that factors into their thinking at all, but why would they go double, set themselves up for more criticism when the data isn't screaming for a double and sort of urgent cut, both the CPI data today and the jobs data on Friday?
Well, it goes to what is the model that they're following. If you look at the real views of how should the Fed set policy, why should they be so restrictive today? They're at their employment mandate. Inflation's going in the right direction. They run the risk, versus their own data, which says that they should be basically unemployment's getting to their target, inflation's on the right way. They should be at neutral, not so restrictive. So yes, there's the political noise, but the reality of the data says that they could be at neutral and they should be at neutral.
Don't you think there's a little second guessing on inflation? Yes, all the signs point to the fact that they're moving to target, but they've been wrong on inflation before, and they underestimated it. And there are still pockets of inflation in this economy, like we saw in today's CPI report, that are problematic.
But it's the singular point of shelter. And the shelter is such a crazy number. When you put in a more real-time number, you have 1.2% headline inflation. Where's the problem? Where's the problem? So, it's just that one singular point. The commodity stuff, the census stuff is going down. Our view is that's trending in the right direction. And they definitely risk being too high for too long.
Yeah, looking at the charts that you published, looking at some of these alternative shelter metric charts. Finally, we mentioned crude a couple of times, but I wonder how certain that is as a dynamic that would prevent CPI from rearing its ugly head again.
Well, that's one of those other things. That's very sensitive. Commodity prices have been trending down, so that's positive for the inflation dynamics. If there was a real spike in that, you'd say that'd be more worrying, but that's not what the current trend shows. It's been actually heading in a cooler trend. That's also positive for all these inflation dynamics.
So what if they don't do it? Jeremy, is the market going to throw a fit? I mean, we're seeing something like that today. We're down 600. I'm not sure if that's what this is about, but if they don't follow your advice, what happens?
It's when you put probabilities of the slowdown, probabilities of recession, it's hard to give you an exact number. We're just saying they're running extra risk, that they don't need to take that extra risk. Cutting would lower the probability of the slowdown and recession, and that's where we think they should be.
We'll see what we get out of retail sales as well. That's come to the rescue before on these short-term growth scares. Jeremy, thanks.
I actually liked his take a lot today, and could explain why markets were down so much in the beginning of the trading day. A little bit of a Fed's going to be too late, growth scare could have been part of it. Now, what's actually interesting about markets today is, yes, the S&P has bounced back quite a bit, but if you look at the percent of stocks currently trading above their 50-day moving average, you're down a lot still. You have about 4% of all stocks today breaking below their 50-day moving average, down to only 41.4% of stocks currently trading above their 50-day moving average. So even though you recovered a lot today, the average stock didn't recover that much. You can actually see the RSP, the equal weight S&P, is still down 0.62%. You can see the Russell 2000 is still in the red, as well as the Dow, which is down 0.5%. So the equal weight S&P is underperforming by quite a large margin the other indexes. NASDAQ is the index doing the best, led by, you guessed it, big tech. Nvidia is up 5%, Google's up 0.5%, Microsoft's up almost 1%, Amazon's up 0.2%, Meta's up almost 0.5%, and so is Apple, up almost 0.5%. And it seems like today we're just going back to the same old defensive playbook. Big tech. That's where you want to be if we go into a recession, if inflation spikes again, if the Fed makes a policy error. And I think that is why a lot of stocks that are consumer discretionary, a lot of value stocks that have been outperforming as the markets have said, hey, the Fed might be a little bit behind the curve, but they're going to get this right. We're going to have a soft landing. Big tech was really underperforming in that environment, because why would you own big tech if we're going to actually have a soft landing? If the Fed's going to get policy right, I mean, they're not the ones that are going to benefit from that. Big tech has been the one that has benefited from rates staying higher, from there being this fear of a recession. Would you rather own, let's put it like this, would you rather own Microsoft, or would you rather own Restoration Hardware or Nike or, a discretionary company if we go into a recession. If you said anything besides Microsoft, then we have a problem here, okay? You'd rather own Microsoft or really any of your other big tech names besides or in spite of your value names, right? Your cyclical names, your consumer discretionary names. And when big tech catches a bid, it tends to help out the broader markets. But again, really under the surface today, it's not a great day, even though markets have bounced back quite a bit. It's really just big tech, which again is a defensive move. That is a risk-off recessionary move when you see big tech leading the markets. Again, because if we go into a recession, big tech is seen now as the defensive place to be. Healthcare and utilities and these other areas used to be seen as the area you'd want to be in if we went into a recession, but these days it's big tech. And I think this also shows a lot when Tesla is really one of those big tech names, but is down 1.4% today because Tesla is not really a stock you'd want to be in if we go into a recession, right? Tesla's not your big tech defensive trade. Tesla is your big tech soft landing leveraged trade that you'd want to be in for a soft landing, right? It's not the defensive recessionary trade, and that's why Tesla's underperforming today, which further just validates the point I'm making. So I actually think today has not great implications for the economy and for the markets as a whole. Especially as we head into the first Fed rate cut, you don't want to see big tech leading. You don't want to see recessionary defensives like big tech leading. You would want to see small caps outperforming. You would want to see value and cyclicals and consumer discretionaries outperforming. And that's not what you're getting today after this CPI report, which is quite alarming to me. So despite Tom Lee and some others making the bull case today, I think the markets are actually screaming, we have a problem. So let me know what you think about this information down below in the comments section. You guys have a fantastic rest of your day, and I will see you in the next one.